basically what we need to figure out is how much growth do we need every single year in order to reach these goals. And so once you figure that out, it could be a 10% return, it could be a 5% return. Obviously, those are two very different portfolios. This week, I'm asking the question, how much risk are you taking? So many of you have 401ks or retirement plans, and a lot of times you're invested in a way that you don't necessarily quite understand. And the reason why I'm saying this is because that's a common thing that I see when I start working with clients that have never talked about investments, never really explored investments before. Even if you've had these things for 10, 20, 30 years, it's a very common thing that I hear that, you know what, I don't really know what's going on, how these things work. And it's important to understand these things because there is some risk in the short term, especially if you do the wrong thing at the wrong time, as far as not understanding and then doing something that's going to really hurt you in the long run. So it's important to understand how much risk are you actually taking. Most of the time when you sign up for your retirement plan through your employer, they'll automatically default you into something that's called a target date fund or an age-based fund. And really what that does is it looks at your age and it projects out when are you going to turn age 65. The longer that time period is, so when you start early in your career, it's longer, it will actually be really, really aggressive, and not aggressive to the point where it's not going to be diversified. That's one of the beautiful things about your 401k and your retirement plans is these things are usually mandated to have diverse investment options. If you choose your own thing, you might not be as diverse as you may want to, but when you're automatically put into something, usually those are going to be very, very diversified. So you don't have to worry about that aspect of the risk, but you still want to know if you're really aggressive, what that could look like during 2008, 2009 market crash. We also saw earlier this year that there was a huge amount of market volatility where the stock market took a huge fall pretty quickly. It's recovered pretty well since then, but at the same time, it probably didn't feel great if you didn't understand what was going on. So the more risk you're taking, the more potential downside there could be in the short term. So it's important to be aware of these things. Also, if you're aging and you're closer to age 65 and you're in those target date funds, those things reduce the risk substantially to the point where you might not get the amount of growth that you would like to see. So when the market is doing really well, and if your portfolio is not, it's because you're not taking as much risk as you maybe could be. And so it's important to know how much risk you're taking and why things go up, why things go down. Make sure that you are informed. I think how much risk you're taking is important to know and understand before you start seeing volatility, because that will help you better navigate insecure financial times when things are getting very volatile. You'll be able to navigate that a lot better because you actually expected and knew what could possibly happen. That's not even the best question to ask revolving risk in your investments. Actually, the better question is how much risk do you need to take? And this isn't the exact math to doing this, but this is a good visual, I think, to get you pretty close ballpark idea to understanding how do we even back into these things. So the growth needed, it's going to equal the cost of your goals. So whether it's retirement, whether it's travel, whether it's buying and replacing vehicles, all these things that you're going to need money for, that's the cost that's going to be associated with this. So that's a huge number when you kind of look at this year, next year, and the next 40, 50 years. And so that's a huge number. Then you have to look at both your current assets and then what you're going to be saving towards these. Those things have the potential to grow if you invest them. And that's kind of where we back in. Just saving alone, if you're just putting everything into a cash savings account, you are not likely going to be able to cover the cost of all of your goals unless you just keep a really low spending. The problem is things don't cost the same amount as they do today. Things go up with inflation every single year. If you are used to living off of $50,000 of income, 20 years from now, you're going to need a lot more, like $100,000 of income to survive. And that continues to double every 20 years if the statistics hold of about 3% inflation rate. So that's why investing is going to be helpful for these things. It helps you counteract what inflation does, and it puts your money to work for you in better ways that maybe you could utilize it. So when it comes down to it, your savings, your future resources, and your current assets that you already have, so the accounts you've accumulated in your 401k and other investment accounts, these things will grow over time. And basically what we need to figure out is how much growth do we need every single year in order to reach these goals. And so once you figure that out, it could be a 10% return, it could be a 5% return. Obviously, those are two very different portfolios if that's the case. And so it's good to know these things in advance, because you'd have to be a lot more aggressive if you needed a 10% return. And let's say for that example of someone that's closer to age 65, they might not be taking that much risk. They may not be that aggressive to make that 10% even be a possibility. So that's why how much risk do you need to take is actually a more appropriate answer, because you do want to achieve your goals. You want to understand what the situation is if you're not on track, how to possibly put yourself in position to make the growth that you need over time in order to make sure you don't run out of money in retirement, to make sure that you're able to do all the things and live the lifestyle that you want to live. If this makes sense to you, there is a assessment that I use with my clients. It's called the investor profile. Just reach out. It doesn't take me too much time because it's a service that I use. Shoot me your email and let me know that you want the investor profile. I'll get this sent to you, and you actually get the results as soon as you take it. It takes like 8 to 10 minutes. That'll give you a little bit more information as far as risk and the different potential returns you might get on different types of portfolios. And so that's super valuable. That's what I use with all my clients when we have the investment discussion. And just ask for it and I'll be able to send that to you pretty quickly.